Hey everyone, and welcome back to the channel. In today's video, we're going to dive deep into the 2022 ICT mentorship setup by Michael. Now, ideally, you should have already watched his 2016 and 2022 mentorship series before jumping into this course. But don't worry, we've structured this video in a way that even if you're completely new to the ICT concepts and have no idea what the 2022 setup is, you'll still be able to follow along perfectly. That said, I highly recommend going back and watching those course series later to truly master these concepts. What is price actually looking for? In the ICT style, we always say that the market is only looking for two things: liquidity or imbalance. So, where is this liquidity sitting? For the most part, it's resting right below old lows and right above old highs. We call these liquidity pools. Specifically, you'll find them at the previous day low or previous day high, the previous week low or previous week high. These are the exact spots where retail traders love to place their stop losses. They look at a bullish trend and think, alright, the market is pushing up, so I'll just safely tuck my stop loss right under yesterday's low or the last daily swing low, and let the price run. But guess what the market does? It drives straight down, sweeps yesterday's low, triggers all those stops, and then takes off in the intended direction. Session liquidity and trend lines. Aside from daily and weekly highs and lows, we also have crucial levels coming from different trading sessions, like the highs and lows of the Asian or London sessions. Typically, we focus on the market kill zones. For example, during the New York Silver Bullet or afternoon sessions, we often see price run the London session highs or lows before reversing and moving in the opposite direction. Liquidity is usually resting above and below previous days, weeks, or sessions highs and lows. Also, if you see a trend line, remember what we discussed before. These form low resistance liquidity runs, meaning there is a massive amount of liquidity engineered right behind them. The second thing price hunts for is an imbalance. If you have a fair value gap, FVG, a volume imbalance, or other market gaps, price will naturally want to draw to them. Personally, I don't trade currency gaps that much in Forex, but if you trade indices or the futures market, they are incredibly powerful. Michael covered market gaps thoroughly in the 2023 mentorship, so feel free to check those videos out for a deeper dive. So, it's always either liquidity or an imbalance. When price returns to an FVG, it's reaching for internal liquidity. It taps into that imbalance and then resumes its trend. On the other hand, the liquidity resting above highs and below lows is what we call external liquidity. Now, how do we actually trade the 2022 setup? Let's say the market is bullish. Price is pushing up from a lower low and reaches a pool of buy-side liquidity. This could be yesterday's high, the Asian session high, or it could be tapping into a higher timeframe imbalance, like a 4-hour or daily FVG. In the 2022 setup, liquidity and imbalance always go hand in hand. Once that old high is swept or the higher timeframe FVG is hit, we look for a shift in market structure. We want to see price aggressively break the most recent swing low, creating a market structure shift. Once the MSS happens, we wait for a retracement back into this newly formed dealing range, measured from the absolute highest point of the sweep down to the swing low of the displacement. Per our rules, if we want to take a short position, we must sell in a premium, meaning above the 50% equilibrium level of this dealing range. We look for an FVG sitting in premium. Entry point, right at the FVG in the premium zone. Stop loss, above the FVG, or safely above the swing high, range high. First target, the current range low. Next targets, subsequent sell-side liquidity, like the previous day low, Asian low, or any low resistance liquidity runs. We scale out with a highly reasonable risk-to-reward ratio. For a bullish setup, it's the exact opposite. Price sweeps a series of lows to take out sell-side liquidity, followed by a sharp displacement higher that gives us a market structure shift. Now, we wait for a pullback into our new dealing range. To go long, we are strictly looking for entries in the discount zone, below the 50% level. We look for an FVG or a full gap. And hey, if you find a balanced price range down there, the setup becomes significantly stronger. Entry: tap into the FVG or BPR in the discount zone. Stop loss: below the FVG or below the absolute swing low. First target: the swing high of our current leg, internal liquidity. Next targets: external liquidity based on the previous price legs. Let me clear the chart real quick to explain targeting and taking partials properly. Let's say price dropped from this higher level down to this point, leaving an old swing high behind. When setting your targets, target number 1 is always the high of the current dealing range. Next targets can be based on low resistance liquidity runs on your left. Alternatively, look at the previous price leg. If there is an FVG sitting in the premium zone of that older leg, above its 50% level, that's an excellent target. So, we trade from this discount all the way up into the premium of the previous leg. But here is the golden rule of risk management. When price hits the 50% equilibrium of that previous leg, especially if there's an FVG there, you must take partials. Lock in some profits. Once you pay yourself, you can risk-free the rest of the trade, move stop to break even, and let it ride to the end of that price leg. But never skip taking partials at the 50% mark. Alright, I hope you guys aren't tired yet. In the next video, we'll talk about when the MSS for this setup is actually valid and when we can look for an entry. I'll see you in the next one.